Most definitely. Thing number five, Gary, talking Treasury auctions. Thing number five on this week's version of the five things, Treasury auctions getting larger and also weaker.
Last week, Rob, we had Mark Rossano from C6 Capital on, and Mark was talking about this issue on the size of the Treasury markets. And he made some great points. There are also similar points to ones you and I have made on this show previously. Basically, what we've been saying is that government spending levels are unsustainable and worsening. So, as the government takes on more and more debt, that means the treasury auctions have to get larger, right? If you take on $100 billion of debt, you have to finance that, and you have to have $100 billion of auctions to finance your needs. But if you take on an extra $1 trillion of debt, well, now you're financing 10 times as much. So that is leading to larger treasury auctions, but there's another part of this that's crucial. And when you take a look at the graph that Andrew's going to throw up here, you'll see at the end on the right side of the graph, there's a big increase in the auction sizes, particularly at the shorter durations, the 2-year, the 3-year. So what Treasury Secretary Yellen is doing is she's shortening the duration on our Treasury yield issuances. Sorry, our Treasury debt issuances. I said it wrong the first time. And what that means is she's issuing comparatively less 20 and 30-year bonds and doing more 2 and 3-year notes. And the reason that matters is because if you finance for a shorter term, you have to finance more frequently, right? So think about it. If Rob, let's say we had to finance $1 trillion and we do it through a 10-year note, right? So we'd finance it, and in 10 years, we'd have to refinance the $1 trillion. But what if you were doing it 1 year at a time, right? All of a sudden, year one, you do 100 billion. Actually, you'd have to, every year, you'd have to refinance that $1 trillion. And so when Yellen goes to the shorter end of the yield issuances here, sorry, I keep saying that, the debt issuances here, that means the auction sizes, by definition, have to keep getting larger and larger. And so what we're seeing is it's the universal law of supply and demand. We have an increasing supply of treasuries, and the demand isn't increasing with that. And so we're seeing at times higher yields, but we're also seeing larger tails. And what that means is the auctions aren't going as well as the government had hoped or expected.
Gary, the U.S. Treasury expected to reach record levels of issuance later this year. Again, kind of going back to Fed cuts, their argument trillions of dollars could be a sign of encouraging that cut. But you're saying it's crucial to remember that those yields are determined by the market. Tell us more about that.
So we had a really interesting discussion again on Twitter or X. I was writing about this, and somebody chimed in that if the Fed would just cut rates, we could cut our interest expense. And my answer is sort of, right? So, yes, when you cut the Fed funds rate, in general, the rest of the yield curve comes down as well. So if you cut the Fed funds rate, you can expect the 2-year and the 10-year and the 20-year, 30-year, those yields tend to come down. However, there are two key things to remember. One is the Federal Reserve only has control of the Fed funds rate. That's the overnight rate between banks. Every other duration, whether it's 1 month all the way out to 30 years, is set by the market. The other thing is when you lower rates, you end up with an increase in inflation. So if you end up with an increase in inflation and you go further out the yield curve, right, to your 5-year, your 10-year, your 20 or 30-year, the expectation will be that rates will have to be higher then. And so there's no guarantee that by lowering the Fed funds rate, if the market perceives that to be something that would create future inflation, you can end up with the outer end of the yield curve going up on a Fed rate decrease. Now, do I think that's going to happen on day one? No, but if you're running, a $35 trillion bond issuance portfolio like the Treasury is, you really need to be planning for more than day one. This is the kind of thing that could lead to disaster down the road.